Right now, as you watch this video, there are more US dollars circulating outside the United States than inside it. Not metaphorically. Not approximately. Literally, trillions of dollars moving between banks in London, Singapore, Tokyo. You buy dollars that were never printed by the Federal Reserve, never authorized by the US Treasury, and never touched by American regulators. And here's the part that should stop you cold. The Fed cannot control them. Cannot track them fully. Cannot regulate them. Cannot even accurately count them. This system has been running since the 1950s. It finances global trade, fuels sovereign debt, underpins currency markets, and quietly determines whether credit is cheap or crushingly expensive for billions of people across the developing world. It has triggered financial crises on 5 continents. It amplified the 2008 collapse. It nearly detonated the global economy in March 2020, and almost nobody in mainstream financial media talks about it by name. It's called the Eurodollar System, and once you see it, you cannot unsee it. Let's define the term, because it confuses almost everyone the first time they hear it. A Eurodollar is not a currency, it is not a euro. It has nothing to do with Europe specifically anymore. A Eurodollar is simply a US dollar deposited in a bank outside the United States. That's it. A dollar held in a London bank, a Hong Kong bank, a Cayman Islands bank, the moment it leaves US jurisdiction, it becomes a Eurodollar. And those dollars, once offshore, operate in a completely different legal universe. They are not subject to Federal Reserve requirements, not subject to FDIC insurance rules, not subject to most US banking regulations at all. They exist in a kind of sovereign no man's land, internationally active, globally powerful, and almost entirely in the shadows. Now here's what makes this genuinely extraordinary. The Eurodollar market isn't some boutique niche for offshore tax havens. Estimates put the total size of the offshore dollar system at somewhere between $13 and $57 trillion, with the honest answer being that nobody actually knows, because by design, this market does not require comprehensive reporting to any single authority. To give you scale, the entire US GDP is roughly $27 trillion. The Eurodollar market may be larger than the entire American economy, operating outside it. Unregulated. How did this happen? How does a market this large simply exist, and why has it never been dismantled? To answer that, we have to go back to a hotel in Moscow. In 1955, the Cold War, the Soviet Union held dollar reserves, necessary for international trade, but was terrified of keeping them in American banks. If the US government froze Soviet assets, the USSR would be economically strangled overnight. So Moscow did something clever. They moved their dollar deposits to a Soviet-owned bank in Paris, the Banque Commerciale pour l'Europe du Nord, its telex address. Eurobank, the dollars held there became known, informally, as Eurodollars. The name stuck even as the market exploded far beyond any Soviet Cold War tactic. By the late 1950s and early 1960s, American corporations operating in Europe realized they could deposit dollars offshore and earn higher interest rates than US regulatory caps allowed at home. At the same time, European banks discovered they could lend those same dollars internationally with no reserve requirements, no regulatory drag, and enormous profit margins. The market didn't just grow, it compounded. Every loan created a deposit elsewhere. Every deposit funded another loan. Dollars multiplied through the offshore system in a way that had no American oversight and no hard ceiling. By the 1970s, after the collapse of Bretton Woods and the end of the gold standard, the Eurodollar system became something even more powerful. OPEC nations began pricing oil in dollars globally. Petrodollar surpluses flooded into offshore dollar accounts. The Eurodollar market became the primary channel for recycling global trade surpluses, and the Federal Reserve watched it grow from a distance, with very little ability to intervene. Through the 1980s and 1990s, the Eurodollar system quietly became the skeleton of global finance. International trade contracts, oil, commodities, shipping, manufacturing, were denominated in dollars even between countries that had nothing to do with America. A Japanese company buying Brazilian iron ore settled the transaction in offshore dollars. A German bank lending to a South Korean manufacturer used Eurodollars. The dollar became the universal language of global commerce, and the Eurodollar market was where that language was spoken most fluently. This gave American banks enormous advantages. It gave the US dollar a structural global demand that kept it dominant even as America's share of global GDP gradually declined. And it gave the entire international financial system a shared dependency on a dollar-based credit system that nobody officially governed. The key word there is credit. The Eurodollar system is not just about moving existing dollars around. It is a credit creation system. Offshore banks lend dollars they don't fully possess against collateral chains involving treasuries and other instruments in transactions that look like traditional banking but operate without traditional safeguards. When credit expands, the global economy breathes easy. When it contracts, when Eurodollar banks get nervous and stop lending, the effects are felt everywhere, almost instantaneously. The global financial crisis is usually explained as a US subprime mortgage problem, and it was. But the mechanism that turned a housing correction into a global catastrophe was the Eurodollar system seizing up. As mortgage-backed securities collapsed in value, the collateral underpinning Eurodollar lending became suspect. Offshore dollar credit froze. Banks in London, Frankfurt, and Tokyo that depended on overnight Eurodollar funding to operate suddenly couldn't roll their positions. Dollar liquidity vanished internationally, not in New York, but everywhere else simultaneously. The Federal Reserve had to open emergency dollar swap lines with foreign central banks, essentially becoming the lender of last resort for a market it had never officially regulated and barely understood. The Bank of England, the European Central Bank, the Bank of Japan, all came to the Fed, asking for dollars to plug a shortage that existed entirely outside American borders. Then it happened again. March 2020, as COVID fear gripped global markets, Eurodollar funding froze within days. The dollar surged violently against almost every other currency, classic signs of a global dollar shortage. The Fed responded with the largest, fastest expansion of dollar swap lines in history. Within weeks, hundreds of billions had been deployed to patch a market that officially doesn't exist. Here's why this matters right now, in 2024 and beyond. The Eurodollar system is showing stress signals that echo 2008 and 2019. Cross-currency basis swaps, a key measure of offshore dollar tension, have been persistently negative in major currency pairs, indicating structural dollar shortages in the offshore system. Emerging market central banks are burning through dollar reserves at rates not seen since 2015, and global trade finance, the bloodstream of physical commerce, is quietly tightening. Here's the data that should make you sit up straight. The Bank for International Settlements estimated that offshore dollar-denominated debt obligations, money that must be repaid in dollars by non-American entities, exceeded $13 trillion as of recent surveys. When the dollar strengthens, every one of those debtors faces a larger repayment burden in local currency terms. Dollar strength, ironically, functions as a global tightening mechanism even when the Fed isn't raising rates. Meaning, the Fed can cut rates at home and simultaneously cause a credit crunch in Southeast Asia, Latin America, and Sub-Saharan Africa through the Eurodollar system it cannot control. The most powerful central bank on earth is, in a very real sense, flying partially blind. So, 3 things to take away from this. First, the dollar's global dominance is not maintained by American military or political power alone. It is maintained by the Eurodollar system, by a self-reinforcing network of offshore dollar credit that makes the rest of the world structurally dependent on dollars they don't control. That is an enormous geopolitical weapon, and a profound vulnerability. Second, when you see a strong dollar and assume that means American financial strength, think again. A surging dollar often signals that the global Eurodollar machine is seizing, that offshore dollar credit is contracting, and that's typically a precursor to financial stress, not a sign of health. Strong dollar, global pain, that equation repeats. Third, the Federal Reserve's power is more limited than almost anyone admits publicly. It controls the onshore dollar system. But the offshore Eurodollar market, where trillions move daily outside regulatory sight, operates by its own logic, its own stresses, its own crises. And when that system breaks, the Fed scrambles to respond to a fire it was never designed to prevent. Here's the question nobody in Washington or on Wall Street wants to answer out loud. What happens the next time the Eurodollar system seizes, and the scale is large enough that emergency swap lines aren't enough? What happens when the dollar-denominated debt mountain cracks in a way that can't be patched overnight? We don't know. Nobody does. And that's precisely the problem with building the global economy on a market that doesn't officially exist. If this video changed how you see the dollar, drop a comment below with one word, Eurodollar. It tells me you made it through, and it genuinely helps this channel reach more people who need to understand what's actually running the global economy. Next topic. We go even deeper, why China's attempt to build a Eurodollar alternative may be the most dangerous financial experiment of the 21st century. Subscribe so you don't miss it, and I'll see you in the next one.